Hello, Katerina.
Hello, Veljko. So today we're talking about the topic you were a bit reluctant to start with.
I don't necessarily believe in corporate culture as being real, valid, measurable.
It's very difficult to measure, but yeah, I'm pushing for us to talk about corporate culture because I think it's important. So let me give you a couple of examples. Have you seen a movie? It's a bit older, a few years back. It's called Freedom Writers with Hilary Swank.
I do not believe I have.
So in that movie, Hilary Swank works as a high school teacher. And what you can see is that she totally sets up a classroom environment, creates a classroom culture like no other. And she really gets a group of kids to graduate and go through high school and learn to be curious like no other teacher. So it's a clear example of how a culture was established in the classroom. Of course, we're going to talk about corporate culture, but I just wanted to throw out an example of how you can identify a culture. So if you watch that movie, Freedom Writers, I think you will see an example of establishing a culture that's very vivid.
Tell me about the movie.
You just got to see it. It's based on a real life story. She just does an incredible job teaching a classroom of kids from difficult neighborhoods and understands their viewpoint and figures out a way to get them to want to learn and to be curious and to basically graduate and have a very different path in lives than they would have otherwise. But this is not corporate culture. So let me give you an example of corporate culture, and we'll start with Apple. At the end of December, the Drucker Institute released the Management Top 250 ranking, which ranks companies on customer satisfaction, employee engagement, innovation scores, social responsibility, and financial strengths. So a lot of things that relate to corporate culture. And guess who was at the top of that list? Who was at the top of this Management 250 list?
Given how you started, I'm going to guess Apple.
Yes, that's right, because I've already mentioned a few things about Apple.
Are you sure it's not just alphabetical?
No. Apple indeed has the highest score, but that's funny. So Apple, one example of the culture in Apple, and we're going to go back to Steve Jobs, is the stories that get told and retold in Apple. And usually an ability of a leader to drive meaning in the organization, to infuse this meaning and to connect work that people do to the vision of an organization is very important, especially now when people are looking for meaning in their work. Steve Jobs wanted Mac to boot faster. He basically wanted to have the boot times in Mac reduced by 20 seconds. We're going back in times that are prehistoric to some of our listeners, so back to the late 1990s, early 2000s. So at that time, reducing the boot speed by 20 seconds, it was a big deal because it took a long time to boot up a computer. So the engineers obviously resisted this. And what he told them is that if we take 5 million Macs, which was his projection for the sales at the time, it's much bigger now, times 365 days a year, times 20 seconds, that's 36.5 billion. So basically, he narrowed this thing down that if they were able to reduce Mac boot times by 20 seconds, they're going to save over 16 human lives annually. And that story kept being told and retold in Apple, and the engineers reduced the boot times by 20 seconds. And apparently the story is still alive, more or less. But that's how he's established a culture, and he linked a goal, an operating goal, to a vision that allowed people to really have a tangible understanding and created this culture of what Apple was at the time. He said, let's give life back to the world. Let's give life back to the world.
But so is every goal that management sets culture? You started almost critical of engineers, and then you were talking about how, he set up a very clear goal, very clear, very measurable.
You're digging too deep into it. The idea there was just to see an example of a story told and retold. Stories build the culture. The story itself didn't matter. It was just an example of a story. But basically, stories build the culture. Why? Because corporate culture is basically a set of belief. It's a belief system. But we're running ahead of ourselves. We're getting into definitions of corporate culture. And we're going to dig in a lot more into it during our discussion. For now, let's see what is our main question for today. What's our main question?
Well, the main question is, should investors actually care about corporate culture? And when we say, should investors care, what we are ultimately asking is there a link here to firm profitability? Is there a link here to portfolio profitability? So should investors care? Does corporate culture have an impact on firm value? Does corporate culture have an impact on the value of your portfolio?
Yeah. Well, if we look at it in that sense, another way to say that or ask that question is perhaps what kind of aspects of corporate culture have a negative influence on your returns, on the value of a company? So which type of aspects of corporate culture are dangerous, are bad? So that might be another view on the same question. And corporate culture, as we will talk about, it influences corporate performance, but maybe it's a lot more than that. It also has these ethical and ESG type spillovers on other aspects. But of course, we can keep it more narrow and talk about corporate performance.
No, but I like this because on one side, I think you're absolutely right. I think asking does corporate culture matter is too vague. I think that we really need to focus on which aspects of corporate culture, which types of corporate culture matter. And the other point that you're making there is this idea that perhaps it's easier to identify the types of corporate culture to avoid. Right?
To avoid, that's well stated.
Having said that, let's get on with it. Does corporate culture matter for investors?
Let's do it.
Welcome to Questions in Finance,
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko Fotak. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related.
So, okay, Kate, you're saying Apple is one of the most successful companies out there, and you're trying to convince me that it has something to do with their corporate culture, right? Or at least I think that this is where all of this is going. But perhaps a good point to start this conversation is from definitions, as always, right? So what is corporate culture?
We'll get to the definitions of corporate culture because there's a couple of really excellent definitions of corporate culture that are out there. But basically, we're merging finance, sociology, and psychology. So some angles of management, but not quite. It's basically a finance take on management, I would say. Corporate culture is basically a belief system. So it's something that's unwritten. So for example, John Graham, Gillian Grennan, and Gillian has done a lot of work in this area of corporate culture. Campbell Harvey and Shivaram Rajagopal have a paper titled Corporate Culture Evidence from the Field. This is a paper published in the Journal of Financial Economics in 2022, so pretty recently. They actually surveyed over 1,000 executives and asked them a variety of questions, but a majority, 84% of these executives say that corporate culture is quite important. In this paper, Graham, Grennan, Harvey, and Rajagopal say that corporate culture is a belief system, a coordination mechanism, an invisible hand, how employees interact with one another, a standard of behavior, a pattern of behavior, norms around how people treat people. They also say it's part ethics, part work ethics, and part ambience of the work environment. Culture guides how the company really works. It guides employee actions, but these are not written rules. These are all just communicated without them being written down, understood principles among employees, basically. So when we started talking about, for example, storytelling was one example of corporate culture. So here's one definition, but we're going to dig into it later.
So far, that's one definition by Graham, a set of norms of behavior. Can we summarize it that way, or is that restrictive?
I think restrictive because it's, as you've said, it's difficult to grasp. So that's a big part of it. It's an untold way to talk about norms of behavior, something that drives the group's behavior.
Maybe we can try to come up with defining characteristics, right? So it's something that is shared.
Shared meaning. It's not an individual concept. It's a shared concept among people in the company.
I like this idea that culture is ultimately something collective, something that affects a group. To that point, Geert Hofstede, we're going to talk about him more during this episode because you, Kate, well know he's known for developing a framework for measuring culture across nations. But he has this paper published in the Online Readings in Psychology and Culture in 2011 titled Dimensionalizing Cultures, the Hofstede Model in Context.
It's in reality a lot more exciting than the ways that it's titled. The title is a bit boring, but in reality, what Geert Hofstede has done is extremely interesting.
Absolutely. But here, I really just want to focus on the definition of culture. And what he's saying here is culture is the collective programming of the mind that distinguishes the members of one group or category of people from others, right? It is always a collective phenomenon, but it can be connected to different collectives. Within each collective, there is a variety of individuals. This is interesting how he puts it. If characteristics of individuals are imagined as varying across some bell curve, then the variation between cultures is the shift of the bell curve when one moves from one society to the other. I think that's a beautiful way of putting it into words and thinking about it, right?
Another definition, for example, by Kramers, who contributed a lot to this literature, is that corporate culture is a wide-held beliefs, not written down. Corporate culture assumptions do not arise instantaneously, but are due to repeat success, routine, and the way to do things. Okay, so it's a stock of shared knowledge among employees, given limited human capacity to process and communicate information. Corporate culture allows people to basically share knowledge with fewer words.
It's something that I see a lot of these definitions. It either accumulates over time or it's immutable, right? There are some definitions of corporate culture that talk about it's an unchanging core.
You know, I would not be so fast at pointing out the unchanging. It's definitely very sticky. We will talk about it's things that change culture.
It's something that's also intangible, right?
I think that's a great way to point it out because translating into our finance speak, right, we are always concerned about investment in tangible assets. More recently, like over the last 20-something years, also investment in intangible assets. And you're right to say that corporate culture is a type of an intangible asset.
So maybe we can start from there, right? It's an intangible asset.
But unlike other intangible assets, this one is rarely included on balance sheets of companies, the valuation of this intangible asset. We can see it through performance changes, but it's not really valued on the balance sheet.
My colleague Feng Gu, he's the current chair of the accounting department at Buffalo. And Feng had a very successful book a couple of years ago with Baruch Lev on the end of accounting. One of the big theme of the book is that our current accounting standards are not keeping up with the importance of intangible assets in the modern economy. But so you're saying it's an intangible asset is one that's often undervalued, right?
I'm not saying undervalued. I'm saying
you said it's not valued at all.
On the
in many ways.
On the balance sheet.
Non-recognized.
So that's why you thought about accounting right away.
Of course.
So one thing that we do see out there, and you know, both of us have been recently reading Alex Edman's book, May Contain Lies.
Correct.
Which is, by the way, phenomenal. We totally recommend it. It's a lot of fun. But Alex Edman's, his 2011 paper shows that firms ranked as best workplaces, which are usually the Apples, the ones that have the best corporate culture, have higher future abnormal returns. So corporate culture gets reflected in returns in the long term, but it's not reflected in accounting balance sheet numbers.
You're absolutely right. That paper is really highly cited, Edmonds 2011. We ourselves cited it during our episode on ESG. What it does is it identifies
best places
the best
to work.
places to work
Yep.
for, right? Or at least he uses a survey that identifies them. And this is based on employees' satisfaction, basically.
Right.
Right.
Which the employee engagement score is one of the main parts of this Drucker's Institute Management Top 250 surveys that I talked about at the beginning, where Apple is at the top of it.
Correct.
Not only alphabetically.
Now, it's interesting because I think that one of the findings in that survey is that what's most important to employees is respect and managerial responsiveness. But again, to go back to what we were saying, like, is this paper about ESG or is it about corporate culture? Or is ESG part of corporate culture?
They're going to be, of course, highly related, right? Because culture sets this, as we've mentioned, untold ways communicated across employees without being written down way of doing things. So
it feels to me like, again, we are using this big term corporate culture and we are capturing a lot in it. But when you look at the Edmonds' paper, it's really about employee satisfaction.
that's one aspect of corporate culture that's important. If we were to break down the aspects of corporate culture, so you said that what's important to employees is respect, right?
There's another paper by Luigi Guizzo, Paula Sapienza, and Luigi Zingalas. It's published in 2015 in the Journal of Financial Economics, and it's titled The Value of Corporate Culture.
And that's Luigi Zingalas, who has a capitalism podcast, which we're also fans of. They look at the basically corporate websites to see what companies say as their top corporate values. But it seems like theirs is not the only paper. There's others that find these same attributes. So how is corporate culture actually measured? It is respect. So what you mentioned in Alex Edmonds' paper. It is integrity, teamwork, innovation, and quality. Those are the top 5 measures of corporate culture out there. If our listeners would want to take away one thing from our episode, I think it would be that corporate performance, aka stock returns, what our listeners care about, is related to one of those 5 measures of corporate culture significantly more. Do you want to guess which one of the 5? And let me repeat them again. That's respect, integrity, teamwork, innovation, and quality.
So you thought you got me there, but I did read enough of the literature to know that it's innovation, or I think it's innovation, right?
That's correct. That it is innovation, in other ways referred to as adaptability, the ability of a firm to adapt to changing environments, flow, and innovate, obviously, is more related to higher future returns.
Let me play devil's advocate here for a second. There are really 2 ways of measuring culture. One is what the firm says its culture is. I know from management papers that when firms talk about corporate culture, they talk about innovation a lot. Some of these findings were clear to some extent, right? It was firms say the innovation is important and hence innovation is important, right? The other problem I have with this theme of the literature is that I think that the question that we are asking today, does corporate culture matter for investors? In many ways, it's almost too broad and too ill-defined. I think the correct question is, do specific manifestations of corporate culture, do specific traits matter? Like, does innovation matter? Does integrity matter? But I think that this literature is losing a little bit of the plot in asking, does corporate culture matter?
So let me also come back to the first things that you've mentioned and anchor on integrity there. You said that there's 2 ways to measure corporate culture, kind of what companies say and advertise their corporate culture values to be and what it is in reality.
Correct.
So actually what matters is not what the companies say. So all the research that has examined this kind of says that whatever stated on the website in the pre-scripted reports of companies in terms of how they want to portray themselves, of course, everybody wants to portray themselves as high integrity and very innovative, etc.
Sure.
It does not correlate with firm value. But what does matter is how firms are in reality, whether their employees, for example, say that they have high integrity, whether in non-prescripted communication firms convey certain values as well. So One, it's the non-prescripted way of communicating corporate cultures that matters. And why I anchored on integrity is because that paper by Guizo, Sapienza, and Zingales, 2015, they show that integrity as it's perceived by employees as they look at a survey, not as it's written up on the website of the company, is related to Tobin's Q.
Okay, let me take a step back and translate two things here. So what I just said is that the 2015 paper shows that integrity as perceived by employees is related to Tobin's Q. So I want to define Tobin's Q. That's number one. And what does it mean perceived by employees? I said they use surveys. I would like to mention which survey. So the survey that's used in the paper is this Great Place to Work Institute, which conducts extensive surveys of employees. And what is Tobin's Q? Tobin's Q is really a measure of corporate performance, also managerial effectiveness, but more specifically, how is Tobin's Q usually measured? We usually take the market value of the company, so the market value of equity, what their shares are trading for times all of the shares, plus the market value of debt, divided by the replacement value of all of corporate assets. So imagine if this company burns down, what would it cost to replace all of your assets? In effect, it's a proportional measure of market value to the replacement value of the firm. When we talk about Tobin's Q, we usually use it to measure corporate growth, valuation, and managerial efficiency, because if management is more efficient, if corporate growth and valuations are better, Tobin's Q is going to be higher. So they find that integrity as perceived by employees in these Great Place to Work surveys is related to Tobin's Q. But there's no such association with advertised values, the values that firms advertise on their websites.
They find some evidence that integrity matters, that integrity correlates to Tobin's Q, right? And yet, from this relatively narrow result, they come with a strong conclusion that culture matters. And it seems to me like that's an extremely narrow definition of culture. Why didn't they call this paper the value of integrity rather than the value of culture? I think that was the title, The Value of Corporate Culture. It seems to me like there's a little bit of salesmanship in wanting to talk about culture when really all you're talking about is integrity, right? And second, when you're looking at survey data, are you measuring corporate culture and managerial integrity, or are you measuring employee satisfaction?
I think that employees could be satisfied in an environment with very low integrity too, if they're paid up a lot. So I think that if they're talking about integrity as perceived by them, they are talking about integrity. Being from the former Soviet Union, there's plenty examples of people being highly satisfied, aka the political leaders in environments of very low integrity, because those higher political ranks in the Soviet Union were laden with corruption. So integrity was talked about, high integrity, but in reality, everybody knew that the perceived integrity is very low. And they wouldn't say it in the surveys that the place where they work doesn't have high integrity. But these are political leaders, and we're talking about anonymous surveys of workers.
And yet, regardless of whether you're talking about Russian employees and workers, you have a very different society here, very different social traits than those of Western corporate managers or Western workers.
Let's not mix in societal culture characteristics. Well, I would like actually to talk about societal culture and corporate culture together. That's actually a very interesting topic. As you know, Geert Hofstede has put together 6 measures of societal culture. That's the societal culture, and I'd like to talk about how it is related to corporate culture. He worked for IBM, and IBM at the time had employees from a variety of countries, and he saw that employees from the same country had very similar attributes. So he created this societal culture measure motivated by IBM employees, because there's a lot of variation across countries on various culture characteristics. One thing they look at is long-term orientation, uncertainty avoidance, masculinity and femininity, power distance, how much people like or don't like taking orders from others, and the sense of peace or lack of conflict.
No, and I fully appreciate Hofstede's classification. is that I've never really seen that as being about corporate culture. And, this word culture seems to be used very differently in these two streams of the literature. Most of my research is on things that cross borders. So when you said, let's do an episode on culture, that's the first thing that came to my mind, right? Hofstede and Americans are more
individualistic
than let's say
Swedes.
The Swedes, yeah. And yes, as you correctly point out, we've used this in our own paper, and we've correlated some of these country level attributes to investors' propensity towards socially responsible investing. And yet, this is country level culture. This is not
country level culture does make its way into corporate culture. So there's several studies that look at the background of CEOs and the cultural background of CEOs. And they show that CEO's cultural background gets represented in certain corporate culture matrices as well. So whether you're an Italian by background or Ukrainian, Swedish, or American and become a CEO of a company, that social culture that you have in you will flow into the corporate culture of the firm of which you become an executive. And, Gillian Grennan in her work points out that among several things that can change corporate culture, change in people or management is one of those things that can create a change in corporate culture.
So I will go back to Gert Hofstede here in his 2011 paper, Dimensionalizing Cultures, the Hofstede model in context. And he starts here by saying that, and I quote, most commonly the term culture is used for tribes or ethnic groups in anthropology, for nations in political science, sociology, and management, and for organizations in sociology and management. A relatively unexplored field is the culture of occupations, for instance, of engineers versus accountants, of academics from different disciplines. The term can also be applied to the genders, to generations, or to social classes. Here is where I think it gets really to your point, right? Because I think there is a little bit of a disconnect here where Hofstede's framework was developed originally to compare cultures across countries, but it's often applied in a different way. And he's commenting on this here. He's saying, however, changing the level of aggregation studied changes the nature of the concept of culture. He continues here saying, societal, national, and gender cultures, which children acquire from their earliest youth onwards, are much deeper rooted in the human mind than occupational cultures acquired at school or than organizational cultures acquired on the job.
Oh, can you read that again? What are the societal ones? Gender is one.
Societal, national, and gender cultures.
Societal, national, and gender cultures.
He said these are acquired very early on by youth. And he's saying that these are much more deeply rooted in the human mind and implicitly less likely to change than occupational cultures acquired at school or organizational cultures acquired on the job. And then he gets even more specific. He says the latter, implying organizational cultures, are exchangeable when people take a new job. Societal cultures reside in often unconscious values in the sense of broad tendencies to prefer certain state of affairs over others. Mm-hmm. Organizational cultures reside rather in visible and conscious practices, the way people perceive what goes on in their organizational environment.
Okay, obviously the two are linked. If you have some societal presets, you're going to see what's happening in your organization through that lens, which is what Hofstede caught on in IBM.
Yeah, but let me push back against this concept even a little bit further, right? Because as we've discussed, we use this term culture both to talk about differences across nations and differences across firms. And in the back of my mind, it was bothering me.
Oh, no, we talked specifically separately about societal culture and corporate culture. We talked about how one can get infused in the other if you have a CEO from a different country.
the firm will have certain characteristics that the CEO is going to bring. So that's leaking of societal culture into corporate culture.
But let me quote here. I mean, I went deep here in research, right? I really dug deep. And I dug so deep that I read the Wikipedia page for Gert Hofstede. I kid you not.
The ultimate level of knowledge. What did we ever do before Wikipedia, right?
No kidding. So here it gets interesting. There is a paragraph or organizational level culture in this Wikipedia entry, and it starts saying, within and across countries, individuals are also parts of organizations such as companies. Hofstede acknowledges that, and here they quote him, the dimensions of national cultures are not relevant for comparing organizations within the same country. But anyways, from 1985 to 1987, Hofstede's lab, his Institute for Research on Intercultural Cooperation, actually tried to develop different metrics for corporate culture. And they actually ran this research project, and they actually came up with 6 dimensions, which they claimed described communities of practices within firms. And these 6 dimensions were process-oriented versus results-oriented, employee-oriented versus job-oriented, parochial versus professional, open system versus closed system, loose control versus tight control, pragmatic versus normative.
These different dimensions actually map in with the 5 dimensions that we've discussed. So they're like these maps as well, to where they're really talking about the same thing.
In some sense, you're not wrong that it does seem to me like it's trying to reinvent or apply a very similar.
It's just about people naming the same thing slightly differently.
I know that management loves the upper echelon theory, right? Which is this idea that the culture or personality of people at the top will affect the culture or behavior of the
let me give you your favorite, Darren Acemoglu. So close to both of our hearts because we like his work. Well, listen to this. Darren Acemoglu with Jackson has a 2015 paper where they show that political events reflect and often shift societal cultures. They show that influential political leaders and presidents can shape societal norms and values through policies or rhetoric. So here they're saying certain people can change societal culture. So why is that such a big step to say that certain people, CEOs, can change corporate culture?
I do find this change by itself is a little bit inconsistent with, I know you already pushed back against that, but I still remember corporate culture as the set of immutable norms, beliefs, and this idea that, now you're getting a new CEO and this set of immutable beliefs actually mutates. I have a little bit of an issue with that.
Yeah.
And yet, I don't disagree with it. As a matter of fact, I don't know if you're baiting me here, but you have some interesting work that shows that firm communication is affected by the same political events, right? Did you want to talk about this?
I do. I wasn't baiting you, though. I really wanted to point out that this more recent work shows that corporate culture is dynamic and not perhaps more so than societal culture. So that's another reason why it's more interesting to study culture from a corporate perspective than societal, because corporate culture is subject to the following shocks that can change it. Number 1, internal shocks, and number 2, external shocks. So when we're talking about internal shocks, what can happen is that systems or formal institutions like compensation or close election votes, they can actually influence culture. If the CEO has a certain cultural background as measured by Hofstede scores that we've talked about, or a certain political identity, that can bring about a certain corporate culture that will create a change in it. And also number 3 or C is events. So a firm can enter a new life cycle. So a firm goes from being private to publicly held through an IPO, or there's an M&A or merger and acquisition of a firm, or there's a leveraged buyout where it becomes private again. Those lifestyle events
can create changes in corporate culture. These are all examples of internal events. And then, of course, the firm also can be influenced by external shocks that can shock their culture. Obviously, regulation changes, right? Regulation changes can create new cultures. People, so while a CEO is an internal member, what we study in our Khashoggi paper is how shareholders or investors can influence things in the firm. So these external people and the changes in ownership actually bring about changes in the culture. And also social and geopolitical events such as the Me Too movement or wars can also bring about or spill over from the external to the internal culture. So I just wanted to summarize some of the things that can change corporate culture.
So for example, you're saying Me Too, all of a sudden what corporation becomes more aware of racial issues, the treatment of minorities, and that changes the way the corporation behaves towards...
Yeah, I would say that the general public becomes more aware, and the change in the general public's view pushes for changes in firms as well, because it's basically correlates with firm value. So there's a paper by Antamayo and Henry Survey where they look at some of the Me Too events and the Weinstein scandal. And what they show is that around the time of those events, the share price of certain companies increases. What are those certain companies? Those are the companies with a higher proportion of women as their executives. So it brings about this awareness that it's important and we care, or a certain group of investors cares, and then other companies take a clue. But yeah, I think a lot more research should be done there, and this paper by Ann Tamayo and Henry Survey is like the first step there. But I think it's not only that people within the firm become more aware, it's that external awareness of a topic becomes greater and it spills over to the company.
Some of these changes that you're describing are driven by customers, right? So, right, if my customers all of a sudden are more concerned about racial issues and I'm hiring a minority spokesperson, I mean, let's think Nike and Colin Kaepernick, right? Is this good marketing or is this a shift in corporate culture?
Great point. Everybody who studies corporate culture is concerned with the question, is it an actual change or is it what we call mildly strategic communication? That's a mild way of saying, I don't know.
Well, branding. Let's call it branding.
Yeah. Strategic communication, right? So not actually making changes, but just talking. Talking the talk, but not walking the walk.
Oh, okay. So some sort of...
Strategic communication.
It's not greenwashing.
It's strategically communicating.
Okay. Strategically. Fair enough. We'll stick to that.
Yes, so a key paper here by Kylie and co-authors who in 2021 do something super cool. They go into the earnings calls, but not the prescripted portion, the non-prescripted portion of earnings call. And they quantify firms based on the 5 key dimensions of corporate culture: respect, integrity, teamwork, innovation, and quality from this unscripted portion. They show that what firms message about is indeed correlated with their corporate outcome. So for each one of the corporate culture values, they find a very prominent actual corporate outcome. So for example, for integrity, they feel like firms that have high integrity, they would be less likely to restate their financial results because they would have been more honest in the first place. And they indeed find that firms with higher messaging on integrity have lower accounting restatements. So how firms talk about corporate culture in the cross-section is related to corporate outcomes, and that's Kylie's 2021 work.
So this is interesting. How do we reconcile this with the findings by Guizzo, Sapienza, and Zingales, right? They made a big deal about how the way managers talk about integrity or in general about culture doesn't matter. It's about how they behave rather than about what they say. And their findings seem to suggest that actually the two don't always correlate very highly, right?
So they're not. Kylie is not looking at how the executives, talk about corporate culture in a prescripted sense. What the authors are doing is they're examining that portion of the earnings report that's not pre-scripted. So it should reflect the actual behavior of the firm.
But, what you mentioned brings about another question. We've talked about all of these changes, right? That corporate culture changes. And I mentioned 6 various things that can change it. And then here they're saying that how firms talk about corporate culture actually correlates to actual outcomes, so corporate outcomes. But I mentioned that happens in the cross-section or across firms. So they are not looking across the time series. So they are not looking within a firm and how firms change the discussions of corporate culture. I do a little bit of that in my past paper with Esther Im. And again, a shout out to Esther. What we wanted to know is whether firms talk differently about their corporate culture when there are different political changes in the United States. So to boil it down to a simple question, we ask whether a firm that's headquartered in an area that votes Democrat versus a firm that's headquartered in an area that votes Republican talk differently about corporate cultures, those 5 dimensions: integrity, respect, quality, innovation, and teamwork during different presidencies. So, imagine the presidency of George Bush or Barack Obama or Donald Trump or Joe Biden. Do these firms, Republican voting areas and Democrat voting areas, change how they talk about their corporate culture across different presidencies?
The most beautiful example of this seems to be Zuckerberg, right? All of a sudden, he's going to the gym, he's bulking up.
It's a tough one to disentangle from his life cycle stage. He's not a teenager anymore.
Okay, fair enough. But it does seem that his shift in image has somehow coincided with the election of Donald Trump, right? And so again, is this just messaging? Is this a shift in corporate culture?
So what there's several questions in there. One, you are asking, why do we think, if we document changes, which we do, why do they happen? What's motivating them? And 2, is it AKA strategic communication, which isn't followed by actual changes in culture, or is it like an actual culture change? So I think I'm hearing those 2 questions.
Sure.
So a couple of things there. What we think is encouraging the spillover of societal culture or different presidencies into corporate culture is multidimensional. Number one, there's research showing that political alignment between the president and you, or the CEO or the analyst, really influences your opinion about the economy. So, for example, if you are a Democrat and I'm a Republican, and we just had a recent election of a Republican president, I'm going to be a lot more optimistic and in a euphoric type of way, so over-optimistic about the economy. That result is shown in a variety of papers, like people who are politically aligned have more kids, credit analysts who are politically aligned rank the same company as another analyst that's not politically aligned as having better future performance and prospects. So people have this overly euphoric rose glasses on them when the president in power is aligned with their party. Perhaps this is related to some of this literature on pride, and they're proud and they're winning societal culture, and that spills over to their economic outlook. That's been documented across multiple papers that the economic outlook is significantly more positive for a politically aligned individual.
But that's pretty clear, right? I mean, I vote for Party X because I think that their economic plan is smarter than Party Y. They win. I'm optimistic about the future. This changes my expectations about the future. I don't necessarily see this as a switch in corporate culture.
But let me ask you a question. You as this executive, you as the CEO who is now politically aligned, which one of the 5 categories of corporate culture, integrity, respect, innovation, teamwork, or quality, would you talk more about, because now you have these rosy glasses on? So which one of the 5, integrity, quality, teamwork, innovation, and respect, would you elevate in your discussions now that you have a euphorically more optimistic economic outlook?
I don't really have a prior on that. Why does optimism correlate with
Because if you think things are going to be better economically, you would want your firms to innovate more usually. You would be more willing to open up to more innovation. And you would want to encourage innovation more because you're just more positive on things. We step back innovation when we're not sure and when we are squeezed financially, etc.
Innovation is a risky activity.
Yeah.
And the more optimistic I am, the more likely I am
and
to
take
engage
on the
in
risky
activities. Okay,
Yeah.
Fair enough.
So that's one example and one spillover.
No, I guess in my head, I still have a hard time calling that a shift in corporate culture.
So I'm not saying that this is a shift in corporate culture. I first was answering your question about what is the motivation. So one of the motivation is this more rosy outlook. There's another which spills out into firms talking more about innovation and about quality as well, because that's related to some cost cut measures, etc. But another thing is firms want to create some type of a political hedge when they are politically misaligned with the president. We've seen this real life. Firms have reduced their discussions of DEI and climate risks to align politically when they have previously been misaligned politically with the president. So here's some other examples of corporate culture messaging that might change politically. Now, you said, well, but I don't see this as changes in corporate culture.
Exactly.
You are actually exactly correct. So when we take a look at whether the actual outcomes change, we don't see that. So this is all strategic communication by firms when we're talking about changes in their messaging on the political dimension.
I do feel like these are interesting points about corporate culture in a general sense, but I would like to get us back a little bit closer to the main question, right? Should investors care about corporate culture? Does this translate into firm performance?
Yeah, and perhaps even easier because, as you said, there is a lot to look at, to think about with corporate culture. To simplify it even further is perhaps what should investors guard against or be afraid of in terms of corporate culture? What's bad for their investment?
Okay, that's an interesting qualifier. I guess what you're saying is that corporate culture affects the downside more than the upside?
Where I was going with that is we know that this culture of innovativeness or adaptability is extremely important. So the moment that we see a decline in that measure for a company, we can assume that the future value of this firm will be declining because that's really a bad signal. That's what I was thinking more. So I think that our listeners should watch out for declines in companies' ability to adapt and innovate.
So I did a little bit of research preparing, right? And I found out in my research that MIT apparently has a huge center for the study of corporate culture, right?
Oh, interesting.
I was surprised, right? They have a reputation for being highly quantitative, and then I have to admit I'm not impressed by their work on corporate culture, by the fuzziness of it, right?
You want something concrete. You're fuzzy with this intangible stuff, not very comfortable.
It's true, and yet I'm not sure that I have a problem with all things intangible. I have a problem with all things poorly defined.
I have a problem with all things poorly defined.
At least we agree on this point. So having said that, this actually comes from a report titled Measuring Culture in Leading Companies, and this is by Donald Saal, Charles Saal, and Andrew Chamberlain, dated 2019 and published in the MIT Sloan Management Review. By the way, MIT has this collaboration with Glassdoor in developing cultural metrics. I guess it's important to note these kind of corporate sponsorships to understand where the money is coming from. You understand that there might be potential biases here. This article on measuring culture in leading companies, well, what I mean with bias is, of course, if Glassdoor is paying you to produce research on corporate culture, you better say that corporate culture matters, right? Anyways, this MIT report starts by saying that corporate culture matters, surprisingly. And then the next sentence is, a healthy company culture can turbocharge corporate performance. This same survey they quote a survey earlier, of CEOs and CFOs, found that 9 out of 10 believed that improving corporate culture would increase the company's valuation. And nearly 80% ranked corporate culture among the 5 most important factors driving the company's valuation.
You know where this is coming from? This is coming from the work that John Graham and Gillian Grennan have done.
So.
They've created a survey of executives and they've added some of these extra questions about culture. If you read their joint paper, John Graham's and Gillian Grennan's, they start off with exactly what you're mentioning. There's a significant majority of executives say that corporate culture is extremely important. And it's unmatched in other things in that survey in terms of importance that executives prescribe to the concept.
And then the next sentence is a growing body of research by financial economists. I mean, this is interesting. These are management people, but they're citing finance research, has shown that a good corporate culture is correlated with a higher profitability and returns to shareholders. Footnote 5. Now, footnote 5 is citing the paper by Guizzo, Sapienza, and Zingales, which is on integrity and firm value, effectively showing that firms committing fraud are penalized by markets. And then it's the Edmonds 2011 paper, again, where he finds that employee satisfaction relates to firm value. Firms that are deemed to be the best places to work for see higher valuations. And there's another paper that they cite here, an economics letter from 2018. The title is Employee Online Reviews and Equity Prices. I took a look. Satisfied employees lead to more valuable firms. Then they have a JFE, crowdsourced employer reviews and stock returns. Again, satisfied employees, higher firm returns. And then they have a paper by Amberline, I don't know the first name, which is actually a Glassdoor research report finding that best places to work for companies actually outperform, kind of an echo to Edmonds. So the big evidence here comes down to 2 things. Fraudulent firms are punished by markets. Firms with satisfied employees outperform.
I would like to add 2 more things to what you've mentioned. You mentioned fraudulent firms and satisfied employees. I also want to add that research has pointed out that a corporate culture value of innovation, or also known as adaptability, is very important for firm value. So let's also add that in, corporate innovation and adaptability. And one more thing that I'd like to add, that besides satisfied employees, what the Drucker Institute ranks even higher in their management top 250 ranking is actually customer satisfaction. So satisfied customers are also very important for firm culture.
But let me hang on to one of the things that you said. You said that the fraudulent culture matters. Totally agree. I think that there's a lot of research pointing that out.
I have a wonderful paper on that.
Oh, I would love to hear about it.
We have a paper with Eric Lee, Jiang Feng, and Hek-Won Lee and myself, where we show that firms that are revealed to be unethical suffer from a higher cost of debt. In other words, when you behave in an unethical manner, your lenders require higher compensation for lending to you. The idea here is that once you have been found to do something unethical, immoral, people don't trust you anymore, right? But the idea here is if you have a lot of unpaid parking tickets, I think you're more likely to run after I lend you money. We make this implicit assumption that unethical behavior spills over commonly, but this literature makes it a little bit more explicit.
Once a liar, always a liar.
Yeah, but I think this is more of a cross-section than a time series. If you lie about X, you're probably lying about Y. But I guess I'm nitpicking. What I want to really highlight here is that there is also a stream of this literature that links religiosity to firm outcomes. And generally, that stream of the literature is also linked to this idea of trust and honesty. There is this assumption underlying here that people will judge other people who are religious as being more trustworthy, less likely to commit fraud, and perhaps more honest about their accounting. And because of that, they will lend them at preferential terms. Grulon, Kanatas, and Weston have a paper that finds that firms that are headquartered in highly religious countries are less likely to commit either fraud or gray area behavior. So they're less likely to backdate options. They actually are less likely to pay excessive compensation to executives. And of course, that's going to be super controversial what's excessive. And they're actually less likely to restate earnings, right?
And relatedly, a paper by Giles Hillary and Kai Y. Hui, the 2009 Journal of Financial Economics paper titled Does Religion Matter in Corporate Decision-Making in America? They look at investment by firms headquartered in more religious areas, and they find that those firms have a lower investment rate. So they build fewer factories, literally, but so they have lower growth, but they actually generate more positive market reactions when they do announce their new investments because they're going to be so well thought through and better investments.
That's really interesting. But I'm not sure, is that a positive or a negative overall?
A positive overall. I guess it's pointing to a lower risk taken by areas that are more religious, which usually higher risk taking is linked to fraud. So that's the connection to this fraudulent behavior there.
I was actually going to cite one more paper that goes back to that connection between lending and religiosity. The paper I mentioned earlier by Grulon, Kanatas, and Weston is across countries. My colleague Jack Feng Jiang, Kos John, Wei Li, and Yiming Qian, they actually have a paper that does something similar at a county level within the United States. The title is Earthly Rewards to the Religious, Religiosity and the Costs of Public and Private Debt. This is published in the Journal of Financial and Quantitative Analysis in 2018. And effectively, what they find is that firms in higher religiosity counties have higher credit ratings and ultimately lower cost of debt. They find that the impact of this is a lot stronger during recessions and bad times. It's a lot stronger when there is a greater degree of information asymmetry. Anyways, I do find this side of the culture, literature, somehow intriguing. I mean, it's almost like religiosity allows you to get to some sort of first principle.
It goes to all the definitions of cultures that we've discussed, right? It's a culture of religiosity in a way, because it's a set of unspoken rules shared among a community of people that defines their behavior, especially in times of difficulty.
I would say within this framework, religion seems to me to almost be a determinant of corporate culture.
Which goes back to, if Gerd Hofstadter's immigrants from different countries coming to the US and working, many of them working in the same firm, that firm's culture is going to be largely influenced by the social culture from the country where these people came from. Same as religion has an influence on the corporate culture. If many of these people are going to church and share the same set of beliefs, I guess there's a bit of a carryover between societal or outside of the corporate culture, cultural traits, and what spills over into the corporate culture.
Exactly. And I think that's the mistake in some sense in some of this literature, which maps societal cultural traits directly onto corporations, ignoring the fact that societal traits are determinants of corporate cultures, but they're really not one and the same. We've spoken in other parts of this podcast about how culture is pervasive to the organization, while in some sense that makes it difficult to study in a scientific manner, because something that's so pervasive is always hard to identify. It also, in some sense, makes it hard to determine the contours of this literature on culture. Because one of the things that I'm noticing is that the more we talk about this, the more I realize there are streams of the literature that in my mind didn't necessarily map onto culture, but that effectively speak about culture. So you're talking about religiosity. There is a very large literature on the impact of religion on corporations. And yeah, ultimately that's about culture. Back to this question, should investors care about unethical companies? Or should investors care about corporate culture? Which ultimately translates into, does corporate culture lead to higher profits? The answer here seems to be yes. And yet what it boils down to is investors should find firms that are innovative, adaptable, and let's say revolutionary. Investors should identify firms with happy and satisfied employees, presumably as a proxy for a productive workforce. And finally, investors should avoid fraudulent firms.
They should avoid firms that have slowed their adaptability or innovation. On the fraudulent firms, they should for sure avoid fraudulent firms, and they should know which firms have like this higher risk culture, are more likely to be fraudulent, because there's a paper by Fachelberg, Perlmuir, and Stultz, 2012, super interesting paper. They basically show that the banks that did pretty bad during the financial downturn of the 2000s, like, when the big tech firm, we had the big fallout, were exactly the same banks that didn't do well in the 2008 financial crisis. So you as an investor should have kind of known, okay, this bank has a bad culture, and whenever the next crisis is around the corner, this bank's going to do worse than other banks as well.
But how could you have known that this bank has a bad culture?
Because these banks performed the worst during the 2000 downturn, and they were again the same banks.
How do you know they perform poorly because of poor culture and not because poor risk
Because
management
this
practices?
is called risk culture. So that's how this is referred to in that paper, the risk culture.
A bad firm underperforms. I mean, imagine working into a consulting meeting, right? And telling investors that after spending millions of dollars on your research, you found out that investors should stay away from firms that are fraudulent and investors should invest in firms that are good at innovating.
A lot of the times, I guess that's what the message will boil down to. Of course, it's going to be a 2-hour seminar that somebody charges like $500,000 for. But it's going to boil down to a consultant saying avoid firms that are fraudulent and invest in firms that have high innovation or adaptability, again, dressed up in multiple examples and ways and stretched through the 2 hours. Do you remember during our episode on short selling, we talked about hedge fund managers that identified unethical CEOs, those CEOs that lied about which schools they went to, where they graduated from. These hedge funds basically sold those firms short, and indeed, they were correct because these firms underperformed, kind of showing that if a CEO is unethical in one area, like, telling us some lies about which schools they went to, they're also going to lie in other areas and perhaps lie about corporate performance, which is going to be then linked to a more negative or worse performance for these firms. And there's other types of CEO problematic behavior that has been pointed out by previous research and then linked to lower firm performance. For example, CEOs that lied about which schools they went to, where they graduated from, who had legal records, who had traffic violations, companies that have option backdated. All of those behaviors are somewhat unethical, and they have been also linked to higher risk cultures or more fraudulent cultures within these firms.
The part that I like the most, where I see some value here, is in the spillovers. You mentioned that paper on CEOs and parking tickets, parking violations, right?
Mm-hmm.
Is that Mityatkov? And
there are actually several papers on this topic, and I think the one that you are talking about is Sergei Braginsky and Sergei Mityakov. It's a 2015 Journal of Financial Economics paper titled Foreign Corporations and the Culture of Transparency, Evidence from Russian Administrative Data. And what they do is they use income misreporting based on the type of a car that an individual in Russia drives. The idea is the following. If you drive a Mercedes versus you drive a very cheap car, let's say a Russian-made Zhiguli or Zaporozhets, but you report the same income, it's very likely that the person who drives a Mercedes is underreporting their income. They also look at what fixes this behavior in a way, and basically, the entry of multinational, more transparent firms than other firms in Russia fixes this income underreporting. And they actually look at employees that join private Russian companies from these multinational firms. So another paper there is Mironov This is Maxim Mironov, 2015, and that's also a Journal of Financial Economics. It's a paper titled, Should One Hire Corrupt CEO in a Corrupt Country? Not surprisingly or surprisingly, they also examine Russia. And what they look at here are traffic violations. So they look at two individuals who are very similar in terms of how much money they make, where they live, and so on. And they find one such individual with very few parking and traffic violations, and another individual with a lot of traffic violations. And so they suggest that the one with fewer traffic violations is the one who is a lot more likely to bribe the policeman, because bribing policemen is a typical thing to do in Russia.
But I find this hilarious. It's such a post-Soviet way of looking at things. We are going to just start by assuming everybody's guilty, right? And then the one that's not getting fined is the one that's paying bribes, right? And so if you're getting fewer fines, you're actually more dishonest, right? I love it. We're just not even going to entertain the possibility that people are actually honest, right? But okay, please go ahead.
And so they look at what happens to these two individuals, and they indeed find that the person who is more likely to bribe policemen, the one with fewer traffic violations, is also more likely to misreport the income for the companies where they work. So this lying behavior continues. But the puzzle in this paper is, and like the question that they ask, is whether it's better to be a corrupt executive in a corrupt country, because they show that specifically in Russia, these corrupt executives who bribe the police and who misreport the revenues of the company, their companies actually perform better than other firms. And there's one more very interesting paper in this parking violation space, and that's a paper by Raymond Fishman and Edward Miguel. It's a 2007 JP, Journal of Political Economy, and it's titled Corruptions, Norms, and Legal Enforcement, Evidence from Diplomatic Parking Tickets. And what they look at the parking by the United Nations officials in Manhattan. Because up until 2002, these United Nations diplomats had diplomatic immunity, which protected them from parking enforcement. So what they find is that a lot of the diplomats from high corruption countries accumulated a lot more unpaid parking violations, meaning they illegally parked while they had this protection. In 2002, there was an enforcement to where these diplomatic license plates of violators were confiscated. Therefore, unpaid violations dropped sharply in response to this 2002 change in regulation. And it specifically obviously dropped from those who were violating before, which were the diplomats from high corruption countries with high corruption indices. So yeah, that was the three papers, Braginsky and Mityakov, 2015, Mironov, 2015, and Fishman and Miguel, 2007.
I thought that was interesting, right? Because what it shows is some sort of cultural fixed effect, if you will, or some sort of integrity fixed effect. Whereas if I cheat on X, I'm more likely to cheat on Y. Right.
Well, back to the paper, the Fachelberg paper on banks. I mentioned that banks in the US that did badly in the 2000 crisis, again did badly in the 2008 crisis. So in case we have a crisis coming in the next year, I'm going to call it. I'm going to say 2026 is going to be a year of extremely bad returns in the US. We can come back to that episode later. But, you know, I think that people shouldn't be surprised if the banks that didn't do well in the 2008 financial crisis, they're going to be the same banks that don't do well in 2026. But there's a paper by Andrew Caroli and his co-author Stabota. It's a Journal of Finance. They show that whenever a bank, and they don't look only in the US, but when a bank from a country that's known to be more corrupt gets acquired by another bank from a country with stronger governance, stronger standards, they actually see that the bank in the target country, in the more corrupt setting, starts being a lot more transparent and increases its standards as well. So there's kind of like this hopeful message that if there's a positive influence by a firm that's in a corrupt setting being acquired by another firm that comes from more ethical background, things change for the better.
But I was under the impression that work by Caroli and Taboada was usually cited as evidence of institutional differences across countries.
And governance, yes, I agree, institutional differences across countries. But again, we've talked about how societal culture can spill into corporate culture. And institutional differences, in this case, you're right. This is more talking about the more formal institutions. I just didn't want to say, these banks that have this high-risk culture will just always do badly during crisis. I wanted to show a window of opportunities that, wait a second, this can change if they get acquired by somebody that has higher standards.
Maybe I'm being unfair in some sense. I get that. Because just because something is nebulous and hard to define doesn't mean it's not real. And maybe corporate culture, people will say culture is pervasive to the organization, right? So maybe one of the difficulties that I have with this is it does affect everything. It does affect my risk management practices. Mm-hmm. And yet there is something on the other side of my brain that keeps saying, we know that all these things individually matter, right? We know that integrity matters.
I think that if over 87% of executives say that corporate culture is the number one most important thing in their firm, I think it really does matter. I think that even an average individual would know what is culture in a classroom, in a company, in their workplace. If you ask anybody, any one of our listeners right now, what type of culture do you have in your workplace? They would be able to understand what culture is in their workplace now compared to their previous workplace.
I would make the complete opposite argument that if you ask 10 people that work at the same firm what the corporate culture is, you will get 10 different answers.
There are several ways of measuring corporate culture. One of them is surveys. So when there's surveys that ask people about corporate culture, actually the employees from the same place line up on very similar characteristics. So I think this brings us to an interesting point. How do you measure this corporate culture? Given that there's so many dimensions, how do you measure this? Maybe this can help boil it down. One is surveys. Of course, It has its own problems. Another one is this time invariant feature, including the risk culture, which you also have a bit of a problem with, and societal culture spill over to the corporate culture. That's two. Another one is things that bring about some time variation changes. And I'd like to highlight the last one that's more promising right now is the linguistic models. So a lot of researchers use the recent language models to pick out culture characteristics of a firm from communications of firms that are not prescripted. So I think that's the most promising current application of creating corporate culture measures for a firm. It's not survey-based. It's not based on these invariant, risk type characteristics, but it's coming from linguistic models to extract corporate culture. Previously, prior to these linguistic models, it was almost as you were saying, it was almost impossible to do research on corporate culture because a lot of it was just kind of blah, 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 and talking about ideas or surveys. And we know all the biases with surveys. But I think linguistic models are making this analysis a lot more interesting, a lot more approachable, and a lot more tangible.
If we were to go back to the core question, should investors care about corporate culture, and what does that mean in practice? Would you have a quick, less than 2-minute, what does that mean for investors? Is there a way to screen your portfolio? Are there easily available metrics that the average... Because I appreciate what you're saying about natural language processing, and yet I'm not expecting, grandma, when she's worried about her pension investments, to download Python and start counting words in a 10K statement. What does this mean for the average investor?
I think an average investor who's invested in, hopefully, they're broadly invested in ETFs. They're not paying attention to individual holdings in their portfolio. They're holding a broad base. But the problem is this current rise that we have in retail investors in the US many of them have concentrated positions in a handful of companies. So I think what we're talking about is more interesting, more important, and more applicable for these retail investors who hold concentrated positions in a few companies because so much of their wealth is tied up in that. And there we have a few pointers of what they need to be looking out for and what they need to be avoiding. We said that they need to avoid companies that have reduced their adaptability and innovation.
One recent example of this, and by recent, I mean, we're at the beginning of 2025. So we will be talking about 2022, 2023, 2024. We can talk about Skechers, Adidas, and Nike. Actually, Adidas and Nike scaled back in terms of the adaptability cultural value, the innovation cultural value for their customer base compared to Skechers. And if you look at the last 5 years of performance, and we're talking specifically here about their stock price performance, and compare Skechers, Nike, and Adidas, there is one clear winner, and that is Skechers. And one reason for that is, again, the way that Skechers has adapted to their customer need has been superior to the adaptation that Nike and Adidas have done over the same time.
But Kate, those are things that are really easy to say now exposed.
Right.
If I'd gone back 5 years ago, I'm not sure how, as an investor, I would have identified Skechers as being the more adaptable corporate culture than Nike, right? And I've seen some of those recent media reports. Skechers understood before Nike did that the real money was in the casual wear rather than real athletes, for lack of a better expression. And again, it's easy to look at the share price of Skechers and at the sales of Skechers and stitch the story that here is a more adaptable company. And we're concluding this because they adapted better.
Yeah. I agree. It's a tough one. Another great example there, right, and that's used by a lot of management people is Sony and Apple, because everybody says that it's Sony that should have invented the iPod. They had all of the components, but that their culture was not collaborative enough and not adaptable enough. And that's why Apple pulled ahead and came up with an iPod, even though Sony should have been that. But again, going with what you're saying, if we lived, which we did, but we probably didn't have investments in Apple and Sony back in the early 2000s, would we have been able to see Sony as lagging on its adaptability and Apple as pushing forward? I don't know.
I mean,
you're right.
The irony is, if I think of two firms that really mismanaged technology despite being technology firms, right?
Kodak.
Okay, you were going to say Kodak, I was going to say Xerox. But yeah, Kodak, Xerox, Sony, they're all companies that exposed these are technology companies that mismanaged innovation and that cost them dearly. Kodak and Xerox a lot more than Sony. And yet, if you open managerial books from the early 90s, and I remember because I was there, these were, page one examples of innovative multinational corporations. It wasn't obvious ex ante that there was something wrong with, and Kodak I wouldn't necessarily put in the same batch. That's why I hesitated a moment, because the biggest mistake of Kodak was a business mistake. They were afraid of cannibalizing existing film business.
Now everybody takes pictures with their iPhones.
Xerox, on the other side, it was just an incredible lack of vision. In late 70s, early 80s, they had an internal internet for exchanging messages, and they had video calls amongst their own teams operating in different countries. So they actually had something that was doing video calls 15 to 20 years before the rest of the world. Yeah. And they used it for internal meetings. They never thought of this as something we can sell. Famously, 2 of their employees invented a mouse, and Xerox decided not to commercialize it because they didn't see any implications for it.
Interesting, so these are vivid examples. What you were saying is, okay, but if we were at the times there, would we be able to actually see that this firm has stepped back on its innovation and it's not as adaptable? Okay, well, I'm going to throw in, that's point number 2. Investors should look out for firms that scale back on adaptability and innovation. Number 2, they should look out for firms that have a high-risk culture, let's call it that way, that haven't done well in the previous crisis, especially banks, because behavior is going to repeat itself. So this way you can look back at the past and figure out who didn't do well. And then if there's an economic downturn, you can divest from those companies because you know that they're going to again do worse.
And there's something I like here about the persistency of behavior that originates from the fact that you have a certain type of culture. I didn't want to make this about our paper, but I go back to one of the things that we find in our work with Eric Lee and Jiang Feng and He-Kwon Lee. So in this paper, we look at option backdating as a proxy for unethical behavior of firms. Option backdating refers to firms misrepresenting when they gave options to executives as part of their compensation package. For a variety of reasons that are effectively connected to taxation, you can maximize the compensation to your managers while minimizing your tax liabilities if you issue call options as part of compensation package on the day when the stock price is at its lowest. Suspicious thing in this literature is that you're often seeing firms issuing stock options to executives exactly on the day when the stock price is at rock bottom. The first people working in this area hypothesized that managers were just really good at timing the market, and yet eventually we found that they're not timing the market. They're exposed changing the date at which options are awarded. Now, this gets even more technical, but most of option backdating is not illegal. It's actually unethical, but not necessarily violating laws. Depends on how exactly it's disclosed. But in our work, we are going to be looking at this option backdating as a proxy for non-ethical firm behavior. And what we actually do find is that when firms are revealed to have backdated options, banks will, first of all, restrict capital that they lend, and then they put stricter non-price terms to loans and increase interest rates on loans as higher compensation for a perception of higher risk. And what we find in that paper is that it takes a certain amount of work. Like, there is no list of backdating firms, right? What you have to do is you actually have to look at when they award options. But the interesting thing, to go back to our investors, is banks were actually doing the groundwork to identify backdaters. The information is public, and yet it does require a little bit of processing. You actually have to look at when they award options, the stock prices, patterns, and compare the two. And it makes sense because in our evidence, we found that the average bank officer is managing 20 loans. The actual number was like something like 16 to 17, right? Whereas what we actually found is that we didn't see these effects in the bond market. And one of the things that we found when we dig into that is that the average corporate bond investor holds something like 1,600 bonds in their portfolio. The fact that identifying this kind of unethical behavior requires a little bit of processing of information. Data is free, information is not. Actually leads banks to do the work. And I mean, if you think about the literature on banking, this is the typical soft information that banks will process, but it's the typical soft information that markets will ignore, right, because of volumes. And one thing that we find in that paper is that after firms have been identified as backdaters by banks, they're more likely to issue bonds than get bank loans. I
see, like to avoid the monitoring and stuff. Yeah, very cool.
To avoid the monitoring of private loans or bank loans, they migrate into the bond market. The implications...
Hopefully they have a way of migrating to the bond market. You're already looking at a select group of firms here who have access to bond markets.
Correct. And one of the things that we find in our paper is a separating equilibrium. The larger firms, for the most part, have access to the bond market, and so they migrate to the bond market. The smaller firms stay with bank loans.
And shrink, get smaller.
Well, yeah, eventually, because either their capital gets rationed and then they grow slower, or they actually find themselves paying higher interest rates on loans, which also affects the future profitability. But again, I think that we were talking about investors from our own paper. I think it's this idea that on one side, corporate culture matters, especially an unethical corporate culture matters because it correlates with other types of unethical behavior, but it's not easy to identify. And yet, not identifying it, not only now you're at risk of lending to somebody who's unethical or investing in somebody who's unethical, but if you ignore these cultural red flags, you suffer from adverse selection. Bond markets are not processing the soft information needed to identify unethical borrowers in the way banks are. Not only now they risk lending to somebody who's unethical, they're attracting unethical borrowers, right?
Right.
Because they're getting screened out by banks. So you get that adverse selection.
Amplification almost. I would say one more thing, probably like you pointed out, requires maybe a bit more looking around or processing. That's going to be, and this is pointed out by Gillian Grannon's recent work, it's companies that talk differently about their corporate culture, those 5 things: integrity, respect, quality, innovation, and teamwork, across different mediums. So on their website, in their earnings calls, in their 10K or 10Q report, in their 8K, in their discussions with the banks, if you see a company, and Gillian Grannon creates a kind of a variable of consistency of their communication that's inconsistent in how they communicate about their culture. Like they say one thing to this group, but then another thing to this group.
Huge red flag.
Huge red flag. That's right.
All of this feels particularly dangerous. From one side, we have all this research saying corporate culture does matter. It does determine for performance. Then 2, we know that you ignore it at your own peril, that if you don't screen out bad companies, they will actually find you, some sort of adverse selection. And then 3, it's all really hard to measure. Perhaps we need to give it a positive spin where there's a gap in knowledge, there's an opportunity for us academics, and perhaps simply our profession hasn't yet developed the right tools and instruments to measure corporate culture accurately. So let's give it a positive spin. Let's look at this as an opportunity for all of us. And clearly some of these new techniques that you were alluding to on language processing coupled with AI, those are really promising, I believe, and give us hope that we might be able to develop some new usable metrics. So I'm looking forward to reading all the interesting research that's going to come out of this over the next years. Yes, let's wrap this up. And Kate, do you want to give us perhaps a brief summary of what we spoke about today?
We've talked about the definitions of corporate culture. We've talked about how you are not very happy with the fuzzy nature of it. And we've outlined the 3 main things that our listeners should pay attention to in terms of avoiding in corporate culture. We can review those again. So what is corporate culture? Corporate culture is really like a belief system, a coordination mechanism, an invisible hand, a pattern of behavior, a set of unwritten rules that allow employees to communicate better, a shared knowledge. We've concluded that there are several main characteristics of corporate culture, which is respect, integrity, quality, teamwork, and innovation. We've also talked about how the stated values of these 5 attributes don't really correlate with corporate performance, but in less scripted corporate communication, their reflection in the less scripted portions of corporate communication does correlate with corporate value. One of the things that correlates a lot is innovation. We also mentioned a few others. And if you are our listener and an investor, you should watch out for bad examples of corporate culture. You should avoid, number 1, companies that start lagging on innovation and adaptability. Number 2, you should watch out for companies that have been known to be unethical or fraudulent or have a high-risk culture in the previous time. Look at the previous crisis because they're likely to not do well in the next crisis. And number 3, red flag, watch out for companies that talk differently about their corporate cultures, those 5 characteristics, to different audiences, employees, investors, loan managers, and banks. So that's my summary of corporate culture.
I guess you are convincing me that corporate culture is important and relevant.
I'm glad we're going to have this in the recordings. That way I can play it over and over again.
I was going to finish that sentence. I guess what I'm still not convinced is that it's actionable. I'm still not 100% convinced that it's measurable, that it is measurable in a way that's truly implementable and useful to everyday investors.
Yeah, it's a challenge.
Indeed.
Excellent. I think we can finish it up at that point. Well, thanks for listening. We appreciate your time. And if you liked our episode, please leave us some comments. Listen to us on your favorite platform. And
send us your questions in finance. Cheers.
Cheers.